Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmer, Wealth Advisor here at Creekmer Wealth. And today I'm joined by John, our Senior Wealth Advisor and founder. And John, we got a whole bunch of stuff to talk about. But before we do, how are you enjoying this fall season?
I tell you, I love it. And fall season is always interesting as far as in the markets. Historically, September has been the worst month of the year. And that's definitely holding true so far in 2023. I know everyone looks at October, and there's always been a couple of large events that happen in the month of October. So sometimes folks look at that as the worst month of the year, but actually September is. And this September, there's a lot of headwinds out there. And I know we're talking about a lot of those today. But that's always kind of made the fall enjoyment kind of a little bit more tempered this year. And but so far, so good. And looking forward to hopping into some numbers.
Yeah, well, let's go ahead and do it. We're going to put a chart up on the screen here that's going to walk through the S&P 500 and show its max inter-year drawdown versus the end-of-year total returns going back to 1928. And John, what you'll notice is there's a lot of green in the total return area, but there's a whole lot of red. And so I think this is a really good thing to be reminded of right now as we're entering the end of this fourth quarter here into the year. And there's a number of headwinds that you mentioned about, just to recognize that the market doesn't always move up and to the right. And so, John, when you look at this chart, what kind of stands out to you?
Well, a number of things. First of all, Drew, can you walk through with everybody, what do you mean by drawdown? What does that mean?
Yeah, so a drawdown is just simply whenever the market falls by a certain percentage point. Doesn't mean it's going down forever, but over a certain period of time, it's maybe dropped by 10 or 15% before it begins recovering again. And so drawdowns happen all the time in the market, and that's something that we are definitely have experienced in the last year and a half or so.
Yeah, so when we look at patterns, we're always in a short-term, intermediate-term, and long-term cycle, and it's either a drawdown period or it's a run-up period. And so whenever you look at periods of time, you can even have drawdowns in the midst of a run-up. And so there's always these different times. And so it's always as healthy, though, to recognize that everything does not always move up forever, nor does everything move down forever. There's seasons where it moves both up and down. But what you can see on this chart, though, is that there are some years when there's some very significant drawdowns in the middle of the year. And yet during the year ends up being very positive. Look at 2020 as an example. Back in March of 2020, there for about 45 days, we saw the S&P 500 drop by 33.9%. And yet over the entire year, from January the 1st to December 31st, it was up 18.4%. Those other times, like in 2022, where the high for the year was actually on January the 2nd. So the very first trading day of the year was the high for the year, and the low for the year happened sometime toward the beginning of the fourth quarter. And it actually was down about 25% from the high to the low, eventually rebounded and being down 18.1%. And so whenever you look, as far as that would include dividends, as far as just on the price of the S&P 500 was down about 19.7%, but you got to factor dividends in there as far as the total return. And so what you want to keep in mind is that we always have seasons, and now a season can last for a longer period of time or a shorter period of time, where we do see drawdowns. And right now, we're in the midst of one of those drawdowns from a high that we saw about a month and a half ago. And in that period of time, the S&P 500 is down about 6.5% so far.
Yeah, and so, John, it's really important. Obviously, drawdowns happen quite a bit more than what I think we would all want them to happen, but they do happen. So how do we manage our emotions and our decision-making process as we're walking through a season where there is a drawdown, or maybe if we're concerned about there being a bigger drawdown in the months ahead? What are the things that we need to keep in mind to make sure that we're making the right decisions to keep us on track to achieve those goals we have?
Yeah, so I think the first thing is you need to define yourself. Are you an investor or are you a trader? And so an investor is somebody that says we're going to actually own quality companies and we're going to own quality funds that own quality companies, and we're investing in those, but we're not trading them. In other words, we're not sitting there trying to buy and sell Apple continuously based upon where it's at within the cycle of a drawdown or a run-up. Now, whenever you define that, and if you're a trader, well, then your reactions will be a little bit different. But if you're simply an investor, which that's how most of our clients are, they're investors, then we recognize there is some seasonality of moves, and we look then to make some adjustments in the short term in which we maybe trim a little bit of a position off, or we look to have a reallocation into a certain area which has a little bit less risk because we believe the drawdown may go a little bit further. The number one thing, though, is you want to make sure that you keep emotion out of the equation and that you simply say, what are the short-term moves I need to make that still help me to realize my short-term and intermediate-term goals? If you have a long-term outlook, though, make sure that you're aligning your decisions long-term with a long-term outlook. Never make a short-term decision to relieve a little short-term pain whenever you're looking at a long-term objective.
Right. Right. And right now, John, we've talked about a number of times over the last few deep dives. There's a ton of opportunities that are out there to help manage that risk and return, especially as we're going into a season with, we believe, some heightened volatility on the train tracks ahead of us. And so we would encourage you, if you've not talked with your advisor yet, reach out to them. Just ask them, hey, what are some things I need to consider to help me make sure my risk is appropriately balanced for the season that we're walking through and the goals that I have? And you'll definitely have a great conversation with your advisor, and we can present a number of different things that you can work on there. So, John, let's kind of transition. One of the reasons why markets have been more volatile in the last 6 weeks or so has been because we've seen the 10-year Treasury yield spike to the highest level since October of 2007. Which, anytime yields go up or interest rates move up, we see bond prices fall. But when yields are moving up, we also see equities or stocks really have some volatility come into play. And so, John, we are in the midst of the worst 3-year period for the 10-year US Treasury bond going back to the 1920s. And so what are some things that people need to be thinking about with interest rates moving up, with yields moving up, and with the bond market in general?
Yeah, so with the bond market in general, keep in mind, folks, the bond market, the U.S. government debt, as far as with the actual government debt, as far as in the bond market, is larger than the U.S. stock market. And so the volatility that it actually brings to bear, it's much more pronounced and is spread across all asset classes. Typically, whenever we look at an investment, we say, what's the risk-free rate of return? And so a risk-free rate of return would be the yield you can receive on a short-term treasury. If you have a goal objective to have a higher rate of return, which is higher than risk-free, well, then you have a certain level of volatility or risk with that. The last 2 years, we saw the Federal Reserve increase interest rates, and they take up from 0% up to 5.5% as far as in their target, as far as in short-term debt. In doing that large of an increase in a short period of time, it actually added pronounced volatility inside bond market investments. So it actually made a bond investment, which historically has been a very safe investment, become a really bad investment because of volatility. We know the Federal Reserve that we lay out as far as the number of governors, 13 governors, and they plot out what they believe interest rates are going to do every single month going forward for 12 months. And they call that a dot plot. And so the dot plot map, what we see from the 13, is that the majority of the Federal Reserve governors believe there's one more interest rate increase coming out November the 1st and 2nd. And then after that, it's going to be a wait-and-see approach to see what happens with inflation, unemployment, and the overall economy. If that starts to stabilize and doesn't get too hot, where they need to cool it down, well, then we do anticipate sometime, and the Federal Reserve governors do also verify this in the dot plot, is that they actually believe we're going to see a decrease sometime in the second to third quarter of next year. So if you have bond investments, you're looking for some stability right now. We believe after the first part of November, whenever we see how inflation data between now and then comes out, and then also whenever we see the Federal Reserve a confirmation with them on the 2nd that they are going to be increasing rates, that may be a good time to look at shifting some money as far as over in the bond allocation, even if you're a growth investor, because we believe you'll be able to lock in a 5 to 5.5% yield. In addition to that, if we see interest rates do decrease sometime middle of next year, you should be able to have some appreciation in the principal. So right now could be a once in a lifetime move as far as with bonds, but we'll have to wait and see how things play out in time.
We definitely will. And obviously, John, history rhymes, it never repeats. But if we were to go back and look at a somewhat similar period of higher inflation that occurred back in the 70s, what we see is essentially the table being set for a 30-plus year bull market in U.S. government bonds. And so, John, to your point, with interest rates having moved up as much as they have, we definitely see that as an area of opportunity for a lot of our clients to be considering in the months ahead. And so, Definitely something to keep in mind there, and something that we'll be keeping a close eye on. Now, John, let's shift gears from markets and let's talk about something that is coming up. Enrollment season is starting here in the middle of October for Medicare supplements. And John, this is an area we've heard a lot about from our clients who want to have some assistance with making sure that they have the right coverage in their current Medicare areas. Can you walk us through what we're doing internally and just give us some things to keep in mind about Medicare?
Yeah, so with Medicare, and as a reminder to everybody, it most usually applies to people that are age 65 and older, and that is what you take as far as paying for your healthcare cost moving forward. It does apply to a unique grouping of people under age 65, and that's in very rare cases. And so it is for folks age 65 and above. And then you also have to ask questions as far as like on your prescription cost, your prescription drugs. Those are not covered underneath Part A or Part B. And so how do you take care of that? Or either other items such as dental and vision. How do you take care of that? And so every year I have phone calls and we send surveys out to all of our clients to get feedback as far as on the top areas that they would like some assistance in that we're not currently working in. And over the last 5 years, sitting either first, second, or third has been some assistance with Medicare. And so we partnered last 2 years with an unbelievably strong firm out in Topeka, Kansas, to be able to give some assist and information as far as on Medicare. But this year, we're actually taking a step further. We're still partnering with the firm out there. And what we've done, though, is we have dedicated a specialist within our firm, Nicole, who has a phenomenal knowledge and experience in Medicare. And she's actually going to be a direct resource for all of our clients. And so as we're heading into enrollment season, starting up October 15th through early December, as you're walking through that, you have questions on your coverage should you make a change as far as in your coverages? Should you have improvements? We have a dedicated resource person internally right now with Nicole, and she will be working with clients this year, specifically in the states of Colorado and Illinois, and then in future years we'll open up to other states. And so if you have questions on that and you're in one of those two states, direct in-house person, Nicole. And if you're outside of those two states, we still have our wonderful relationship with Advisors Excel over in Topeka, Kansas.
Yep. Absolutely. And guys, Nicole has prepared a webinar walking through Medicare as an educational resource for you all. It's actually in the body of this email, so I would encourage you to scroll down. I know I've learned a ton from talking with Nicole about Medicare and from going through this presentation with her. So I definitely encourage you to check that out. If you have any questions, reach out to your advisor and they can make the connection between yourself and Nicole to either review your current coverages or to discuss what coverages you need in place as you are reaching age 65. So, John, I think that's all we have for today. We covered a lot of ground here, but what is the one thing that you want people to keep in mind as we move into the fourth quarter?
Yeah, I'll tell you the one thing to keep in mind is a couple of years ago, I went out mountain biking and out in Colorado, in the state of Utah, and had not gone mountain biking before. And so our guide came up and says, "Hey, you look pretty athletic. I think you'll do great. And so let's go to the top of the highest mountain." So we went up there and he gave me some tips and he says, "Here, we're just going to go." Well, the next thing that I knew as far as in this journey down the mountainside, he was nowhere to be found. And he took off going down the mountain. And I got to a very narrow area. I tried to follow the tips. I got a little bit too close to the side, and I actually fell off the side of the cliff. I dropped down about 15 feet, and I landed in a pile of sticker bushes. Now, thankfully, that saved me from having my head hit a rock. It did cut me up pretty bad, but I finally caught up to him as he was waiting there as far as flew down the trail. You know, all of a sudden I started thinking about that, thinking, I was on a journey in a mountain going up and down the hillside, enjoying some of the view, getting nervous at some of the journey, and yet I did not have my guide with me to help me make those decisions of how I can navigate safely down the mountain. The stage of life where you're at right now, it's a very similar story. And so I want to encourage you, make sure you're not on this journey alone. And as you have questions, as things come up, as you're trying to make decisions or gather more information, as you see things in the media that bring up concern to you, don't go it alone. Use your guide, which is your advisor, and make sure you message them and set up a time to chat about it.
Awesome. Love that story. Guys, if you have any questions, like John said, absolutely reach out to your advisor. We'd love to chat with you about any of the topics we covered today. We have someone standing by ready to help you. Make sure you're making the right decisions to stay on track towards your goals. So guys, thanks for the time. That's all we have today, and we'll talk to you soon.